As always, the views expressed during today's event are those of the speakers, not of Stratford, the speakers' firms, or clients, and are not intended to provide legal or tax advice. We've gathered an experienced panel to provide us with a thorough and practical review of the IPU guidance on substantial compliance for Form 5471, Information Return Filings. Our panel today includes Allison Doherty, Director at Aronson in Rockville, Maryland. She's joined today by Stephen Tosher. Steve is with Hockman, Selkin, Reddick, Tosher, and Perez in Beverly Hills, and Mr. Tosher will be speaking first. So, Steve, when you're ready, sir, the audience is all yours.
Thank you, Don. Allison, good morning or good afternoon, wherever you are in the audience. It's a pleasure to be here to speak for another Stratford program. We hope we can inform you on this very, very important topic. The title is Section 5471, Compliance, Substantial Compliance Rules. But as we go through the material, I think you will see that the analysis could apply to any foreign information reporting. We're at a new era in terms of taxpayer and professional compliance obligations concerning foreign information reporting. I think the new era started 7 or 8 years ago, and the Internal Revenue Service has been much more focused on foreign compliance, whether it is foreign bank accounts, foreign corporations, or foreign trusts. The focus is much greater today. You could have asked an Internal Revenue agent 7 or 8 years ago, maybe not an LBNI agent, but most agents, what is a 5471? And many, many agents would not know the form or what you were talking about. The same might be true for many tax return preparers or CPAs. The paradigm of what was happening 7 or 8 years ago, many instances, a mid-sized company engaged in foreign transactions with a foreign subsidiary would simply not be in compliance. In many instances, they didn't know they had to file a Form 5471, which relates to controlled foreign corporations. As many of you on the audience knows, the controlled foreign corporation rules are somewhat unique to the United States. There are other jurisdictions that have them, but mostly the world is a territorial tax system, not so with the United States, excuse me, as it is right now. So we have these controlled foreign corporation rules, which require a great deal of information reporting, whether or not the foreign activity is actually taxable in the United States. We're not going to get into the details of the taxation of controlled foreign corporations, but rather focus on the compliance with the reporting and efforts to be in compliance and avoid the problems of non-compliance. 7 or 8, or let's say 10 years ago, we deal with IRS examinations where Forms 5471 were not filed. And in many instances, even during an examination, examining agents were quite forgiving, and we would prepare and file delinquent returns, and no penalties were asserted. I hate to tell you, the foreign enforcement world, as you probably are aware, has changed. In almost every case now where there's an examination and there's a problem with non-filing, you have a very, very good chance of being faced with the assertion of penalties. And the recent International Practice Unit, the IPU that Don mentioned, that's the subject of this seminar, is another signal to all of us, not only must there be compliance with the foreign reporting, but the foreign reporting must be accurate, complete, and information left off on the form could cause bad things to happen. And we're going to get into those in a little bit. So what is an international practice unit? This is a teaching device that the IRS, I'll refer to the IRS as the service, uses to teach its agents. I've looked at this IPU a number of times when it came out in preparation for this program, and it is quite good. They have top flight lawyers and technical people going through the law to try to help and give the agents guidance. Likely, most of the agents who received training on this, it might have been similar to a webinar like this, internally or self-study. So it's very important because not only is it good, we may disagree with some of the conclusions, but that aside, it's very good, it's well thought out, it's very complete. And more importantly, it's what examining agents are going to go to when and if the issue of whether the tax returns, the information returns filed are substantially complete. So it serves two functions, not only training for the agents, but signals to us as practitioners and education for us as to what has to be done and substantially complete on the returns. In the second half of the program, Allison is going to get into some very specific issues regarding reporting. I'm going to cover initially the more background and legal issues as to the problem we're all faced. Now, the services IPU and the regulations talk about what is substantially complete. And it's not in all the foreign reporting regulations, but I think in 2 or 3 of them. And let's take a step back and focus on this because this is very important. It doesn't have to be 100% complete. Perfection isn't what's required. It's substantially complete. And I think you're not going to find the words I'm going to give you now, but think of a rule of reason. Just what is reasonable? What should you do? Fortunately or unfortunately, substantially complete, whatever that means, is not defined in the code or regulations. But the IPU does a very good job in reaching out for other areas where the courts and the Internal Revenue Services administratively has dealt with this type of situation. So the question is, and this is the important point, what are the consequences of not having a substantially complete return? And there are 2 very big consequences. One, you may not have a return which was filed. What does that mean? Well, if you recall, unless you have a return that's filed, the statute of limitations relating to that foreign information return does not begin to run. That can have extraordinarily significant consequences. Secondly, as we're aware of, there are very significant reporting penalties for not filing a return. and a return which is not substantially complete, in the service's view, is not a filed return. I would say that it's been probably rare that this is raised by the service, but I think we're going to see a much more increased significance where the service is going to raise it. And I think if we are forewarned, which the IPU does, we are forearmed because we should be able to avoid these going into this. Now, if you look at slide 6, the service immediately looked to, in terms of what is substantially complete, what's referred to in the tax law is the substantial compliance doctrine, developed by the courts in context of whether a tax return, an election, or even the substantiation of certain deductions is enough. Again, it doesn't have to be perfection, but will substantial compliance be accepted? So I've been practicing I was a revenue agent before. I worked for the Department of Justice, and then I've been in private practice about 35 years. We have often used substantial compliance, that judicial doctrine, in a number of contexts. It's a common sense concept. Did the taxpayer try to comply with the law? So what the IPU does, it looks to various case law developed in other areas. And really, there isn't a lot of law in the foreign reporting area concerning what is substantially complete. Many of the cases which get developed, if they do, will be of first impression to the courts. And the court will look at, well, what the regulations say substantially complete. What does that mean? Again, no guidance. And they will look at the substantial compliance cases we'll talk about. They will look at the various substantiation cases, and those will be guidelines to the court as to what makes sense. Now, just an aside for a second, the penalties associated with the failure to file at 5471 is what's referred to as an assessable penalty. It's not a deficiency, tax deficiency, which would normally be an income tax, a penalty related to an income tax, or a state gift tax, and some other types of taxes. But this is an assessable penalty. And there are two very significant implications of that. One, there is no judicial proceeding required before the IRS makes an assessment of one of these penalties. There is no deficiency. An income tax deficiency, they need to issue the taxpayer a notice of deficiency. Here, they do not. They can just assess the penalty. Now, they do provide taxpayers administrative review, pre-assessment, provided the statute is still available. But so they do have a lot more power to get the ball rolling, so to speak, on collection. The second is because there's no deficiency, these issues on the penalties or substantial compliance and whether substantially complete are not going to be litigated in the tax court. They're normally going to be litigated in a refund action in the district court, or perhaps the claims court, or in certain cases, and there is a great deal of law and dispute on this, but in what's referred to as a collection due process case in the tax court. So likely a lot of the law which is developed may not be in the tax court, although most of the cases we're going to talk about today are within the tax court. And the tax court is, in our country, the primary court of resolving tax disputes. So it will be interesting. I mean, I can stop right here and sort of guess, are we going to be getting a landslide of assertions of penalties and incomplete, for potentially incomplete or substantially incomplete returns? I don't know. I tend not to think so. I do know there's an increased awareness of the whole forward information reporting area with the service, and there'll be an increased awareness of requiring greater compliance. But I don't see the sky falling. I do see something we need to be prepared for. So, we get into issues as to, I wish I could say, what is substantial compliance? What is strict compliance? What will be required? And what the materials demonstrate that in some cases, the courts will require strict compliance. In other cases, substantial compliance. It is difficult to say which one will be required. IRS agents may argue we're looking for strict compliance in a certain area, and taxpayer representatives will be arguing we're entitled to substantially comply. Now, if you look at the case law as the practice unit lays out, there's language in the cases which say strict compliance will be required where the error or omission deals with the substance or essence of what is required. Then there's language saying the substantial compliance will be allowed or be the rule where it's procedural or directory. I say these give us some guidance, but this is all going to be, as we go through the examples, very fact-bound, based upon facts and circumstances. And I would submit substance or essence, procedural or directory are sort of labels that the courts put on certain conduct at the end of the day. But really, you have to deal with the facts and circumstances. Now, we are going to deal with, there are other issues that the courts may evolve, which really aren't directly dealt with in the practice unit. But I want to throw out these concepts for you to keep in mind. And one is the concept of materiality. The regulations don't use the word materiality, and materiality is more in the tax area. It is a criminal tax law concept, and and we're going to talk about it in a little bit because one of the GCMs we're going to discuss. A GCM is a general counsel memoranda. It's issued by the Chief Counsel's Office of the Internal Revenue Service. While not a precedential document per se, it is very persuasive. It is a formal opinion of the Internal Revenue Service's top lawyer. So it can be very influential. So the materiality will come in, and that is a pretty broad concept in the criminal tax law. So it's something we need to be aware of. One subject area which is not discussed as to a body of law to look at, and I would suggest would be relevant, but it's not in the IPU, and those are the cases concerning adequate disclosure concerning the statute of limitations under income tax deficiencies under the so-called 6-year rule. If you recall, there's a normal 3-year statute of limitations, but if there's a substantial omission, 6 years. But if there's adequate disclosure, then the 3-year rule applies. Those cases have potential application. And finally, one of the overriding concepts will be, now it doesn't say any here, is good faith. When we talk about the substantial omission, was the taxpayer in good faith? And this is very important. Now, one might argue that, good faith only deals with the reasonable cause exception to the penalty. I would suggest not. I think good faith is a factor that we all need to keep in mind throughout as we look at these things. As you're preparing the returns, as you're dealing with the service during an examination, the taxpayer's good faith efforts and even the professional's good faith efforts do play a role. So it's not only a factor in it's just a practical factor that you're going to have to consider and always keep in mind. Now, just one point, we're talking about the taxpayer, but who do you think the taxpayer will look to if there was an omission in the 5471 or the 5472? He's going to look to the preparer of that form, which places the responsibility on you, the preparer, us, the advisor. So we have to be very careful because taxpayers don't like penalties. The preparer may say, well, they never gave me the information. And the response might be, well, you never asked for it. And as Allison will go through, and those of you on the audience, whoever has been involved with preparing a Form 5471, it is substantially involved. Okay, so let's take a look at some of the cases. And I'm on slide 8, and this is how far back we had to reach to sort of do an analysis. An income tax case going back to 1928. How is that? We're dealing with 2017 foreign reporting, but we're looking to a BTA case. Now, for those of you who don't know, BTA is what was called the Board of Tax Appeals. That was the forerunner to the United States Tax Court. So, Indiana Rolling Hills had to deal with who needed to sign the return, but this is where the so-called substantial compliance and essence test came about. What had happened was, I think there was a regulation which required certain officers to sign, and the wrong corporate officer signed. And so you have to ask yourself the question, why did the IRS argue the return was not valid for a purpose of starting the statute of limitations? You know, sort of a cheap shot, not to be critical of the IRS, but the return was filed, it was signed, but apparently for some reason, my guess, and this is speculation, I wasn't there in 1928, is there was a fairly large adjustment and the statute of limitations had gone. So this was an argument that could be made under the regulations. Now, the important, some of the language, if you look at that, and this is where I picked it up, is the court talked about information fairly and honestly given. Now, they were talking about, the signing of the return, the information was good. But I suggest to you those should be guideposts for you. Information honestly and fairly given. Now, the next one, slide 10, is what's been referred to as the Baird test. The site is to TC, that's the tax court. We're up to 1984. And this is where the tax court laid out the requirements of what a return needs to be a tax return. Again, and for an income tax return, it's same consequences, penalties, and no statute of limitations. And again, I want to point out, you see a factor of an honest and reasonable attempt. Now, we're going to discuss in a little bit how the service will argue in certain circumstances that an income tax return is different than an information reporting return. That's true. It's different, and there are many similarities, and the tests may very well be different. But I suggest that the reason the Baird test is in the IPU is the lawyers for the IRS who wrote it, excuse me, recognize that this may be a source the tax court looks to for guidance. Now, slides 11 and 12 deal with the Taylor case, again, a tax court case, dealing with an election. Again, we're talking about perhaps income tax returns. Here's an election, and this was interesting. I didn't even know what 1251B4 was, but apparently it has to do with the reporting of gain from the disposition of property used in farming. The regulation and statute required a statement in addition to following certain accounting rules. The taxpayer followed the accounting rules, but didn't have the statement that was on the return. Tax court, quite favorable, held that the essence, again, here's the essence test coming up, was following the accounting rules. And just the election, the putting on the statement of the return was directive, and therefore they've substantially complied. What you're going to want to look to this, what a judge is going to want to look to is, was the taxpayer getting away with something? Was the IRS prejudiced by the conduct? Was the taxpayer in good faith? These are the overriding issues. Because remember, we're not talking about what the correct amount of tax is. We're talking about some very serious consequences concerning omissions or errors in the return, in the information reporting return. So all in all, at this point, I would tell you the law, to the extent the courts find it relevant to information reporting, is quite taxpayer friendly. The next group of slides deal with the charitable contribution substantiation requirements. And here we have sort of a mixed bag of cases. I've litigated a case under the charitable substantiation requirements. And I can tell you what was on the tax court's mind is not necessarily the pieces of paper, but the underlying substance of the charitable donation. Both the IRS and the tax court are charged with and want to get it right. And so the underlying getting it right is extremely important. Now, and that will influence what's done in terms of an error on a 5471 or an omission. In Bond v. Commissioner, talked about on slide 13, we're talking about a deduction. And we all know deductions are subject to legislative grace. They're only there because the statute provides. But here, it was the expert's credentials which were left off. And the regulation was held to be, again, directory, not going to the essence of making the contribution. Other cases talked about are not as friendly, I can tell you. Now, but here's a real important point, which I can't emphasize enough, and it's, I guess, contained in the Bond decision here. The key fact to me, the expert's credentials were provided once requested by the IRS examiner. This, to me, is a very, very important teaching point. And that is, we are all going to be faced with situations that we are going to discover that that the information wasn't complete enough. The rules required, Allison may touch on this, are allow some estimates. And quite frankly, anybody who's been faced with this, you may not have enough information to prepare a return or complete return. And is it better not to do the return or do the return with as much information as you have with a disclosure statement? Well, I think the latter is probably the safest course. But so the point is, if you discover after the return is filed that maybe there's additional information that should be reported on it that's not, then by all means, generously amend that return. Again, by generously may be a little too aggressive. You don't want to be, causing unnecessary work and, putting things before the service you don't need to. But if you determine that something should have been on there that's not on there, then you should definitely consider amending it. That's a very, very important point. There's no corresponding provision for what is a qualified amended return in the income tax area, but I would suggest it would be quite relevant. Also, during the IRS examination, if information is discovered that's not there, well, this is the chance to step to the plate and get the information to the IRS agent. Now, is that good enough legally? Well, I think you can point to the Bond case, but I think from a practical point of view, it's something which you should do. We have to go back to the point that what penalties are about. And penalties are about fostering taxpayer compliance and getting back to good faith. The statute of limitations is sort of a different issue. It's sort of a gotcha. And the service would probably only do that if they thought a big transaction, which didn't get reported, needed to get reported. Now, if slide 16 and 17 talk about some conclusions. It's not clear, but my advice is the most important part is facts and circumstances. There's a lot of guidance in here to look at. If you look at slides 17 and 18, 17 is a district court case. You can look at that. It's not that important. But this is a very important point. And this signals to me that the IRS will argue that in information return, there may be a more stringent compliance example or compliance requirement than an income tax return. And in the right case, it may very well be. But a lot of the same factors, essence, directory, good faith effort. I'll commend your attention right now, and then I'm going to turn it over to Allison. to slides 20 through 26. It goes through what we'd call more informal guidance, what's called a field service advice, which is not as formal as a general counsel memorandum, but very important to us in our practice, and other reporting which which deal with the foreign information reporting obligations, and these are going to be very important with you to understand if this issue does come up. With that, I am pleased to be able to turn it over to Allison to start getting into some of the details of the reporting. So now that we have the background, we can see how and where this may come up. Thank you.
Thanks, Steve, for the excellent presentation, and thank you to everyone for taking the time to listen to the webinar today. I certainly appreciate the opportunity to share some of my experience with you in terms of the actual preparation of these U.S. international information returns, and how as preparers and advisors we need to make sure that the forms that the taxpayers are filing are accurate and complete to avoid the U.S. international information return penalties. So the areas that I will cover in my section of the presentation today will include examples of when a U.S. international information return filing is not substantially complete. And we are going to focus, for the most part, on the Form 5471. We'll talk about that in a lot of detail. If we have time, I'll also address some issues related to the Form 5472, and I'll explain exactly, what those forms are and when they need to be filed. We're going to look at, what types of errors can be apparent on the face of the Form 5471 International Information Return, and then some considerations regarding errors that are kind of underlying the return, which may not necessarily be identifiable on the face of the form. And then if we have time, then I'll talk about a couple of the examples from the IRS International Practice Unit guidance. So the Form 5471, this is a U.S. international information return that is filed by a U.S. person with respect to ownership of a foreign corporation. And to be a filer of the Form 5471, you have to have a U.S. person. So a U.S. individual, a corporation, partnership, a state, trust, or in some cases a nonprofit organization can be required to file some of these forms. And for the 5471, there are certain filer categories that can apply. And to figure out if a taxpayer has to file it, you need to figure out if that taxpayer is within the scope of any of the applicable filer categories. So we may go into more detail about exactly, what these filer categories are, but for the most part, if you're a U.S. person and you acquire or own a 10% interest in a foreign corporation, you're going to have a Form 5471 filing requirement. And if that foreign corporation is controlled by U.S. persons who each own at least 10%, then you're going to have an annual Form 5471 filing requirement in addition to the year of a 10% acquisition. And then also, if you're a U.S. individual that is the officer or director of a foreign corporation, you can have a filing requirement in any year when any U.S. person acquires 10%. So the filing threshold that you really need to be concerned about for the 5471 is a 10% acquisition or ownership in a foreign corporation. So in the IRS Form 5471 filing instructions, they have this schedule on page 2, and it basically identifies which schedules of the Form 5471 are required to be attached based on the applicable filer category. So the first key, consideration and analysis that you need to do as a preparer or a tax advisor in advising a taxpayer whether they have a Form 5471 filing requirement is what filer category or categories could possibly apply. And then, to the extent that the taxpayer is within the scope of the filer categories, then you need to look at what parts of the Form 5471 are required to be prepared and completed and filed as attachments to the Form 5471. If any of these required schedules are not attached for that particular filer category, you can have an incomplete Form 5471, which can give rise to a $10,000 penalty. That's the basic penalty that applies for either the late filing of the Form 5471, the failure to file the Form 5471, or the filing of an incomplete and inaccurate Form 5471. So substantial compliance is really critical because if you file an inaccurate or incomplete Form 5471, even though the form was attached to the return, if it's deficient, then that can trigger a $10,000 penalty, which the IRS has the authority to assess. And if the failure to comply continues beyond 90 days after the IRS sends a notice to the taxpayer, then there can be additional penalties stacked on top of that initial $10,000 penalty. So for each 30-day period where there's a delinquency and noncompliance, there can be an additional $10,000 penalty up to a maximum of $50,000 in additional stacked penalties. So the total maximum penalties that can be assessed, that goes up to $60,000 per form, per foreign corporation, per year, per taxpayer. So these penalties are very burdensome and onerous to the taxpayer, and that's why it's essential and critical to make sure that these forms are prepared properly and that all of the required information is disclosed. And again, I just want to point out, this schedule here on slide 35 is, this helps you determine what has to be attached. If you're a Category 2 filer, you attach the first page, Schedule G, and Schedule O, Part 1. If you're a Category 3 filer, then you have to, look where the check boxes are falling next to these specific schedules to figure out what has to be attached. For a Category 3 filer, Schedule O, Part 2 has to be attached. That's different. For Category 4 filer, that's where a U.S. person controls a foreign corporation, you have to attach all schedules except Schedule O. And then for Category 5, which is the U.S. shareholder of a controlled foreign corporation or a CFC, then you have specific schedules that are required to be completed and attached. So what are some examples of when a U.S. international information return is not considered to be substantially complete? So evidently, if all required schedules are not attached or completed, then you're going to have a possible deficiency, and that can lead to the information return not being substantially complete. If you have overstatements or understatements of amounts that are required to be reported, those inaccuracies, to the extent of the magnitude of the overstatement or understatement when compared to the entire information return, that can cause the form not to be substantially complete. If you have incorrect or inaccurate information on the form, that's going to be another area that the IRS can scrutinize and take issue with. If you're not reporting all the required information, and then if you are disclosing financial statements of a foreign corporation, you've got an income statement with net income or loss that does not tie into the change in your retained earnings on the balance sheet, then, that's another, issue that can cause your 5471 not to be substantially complete. So other areas, other examples of, issues that can cause the form not to be complete, where you have related party transactions that are not reported correctly. A big issue to be concerned about is, are you checking the correct filer category boxes on the first page of the Form 5471? It's, certainly a red flag right away if you're not disclosing all of the applicable filer categories for that particular taxpayer, because it may mean that you're not attaching all of the required schedules. You can have a situation where acquisitions and dispositions of foreign corporation stock are not being reported and disclosed properly. Reorganizations of the foreign corporation are not reported on the Schedule O. For Form 5472, if you're not reporting direct and indirect foreign shareholders of a U.S. reporting corporation, that can lead to an incomplete Form 5472. And for any foreign entities, foreign companies, or foreign-related parties that do not have a U.S. taxpayer identification number, you have to create a reference ID for those foreign parties. And if you're not disclosing a reference ID number, that's probably not going to cause the entire information return to be substantially incomplete, but certainly it could be an issue when taken together with other deficiencies, which might result in a substantially incomplete information return. So I want to take a look at some errors that would be identifiable by the IRS on the face of a Form 5471 International Information Return. These are some key, areas that are practical considerations for you to be aware of. To, if you're just doing a high-level review of a 5471 as an attorney, as an advisor, to provide support to a taxpayer's CPA or tax return preparer. These are some things that, while you haven't audited the information return, you could easily identify from the face of the form. So it doesn't take, a tax partner necessarily in an accounting firm to be able to pick up on some of these issues. It just takes, some practical experience and understanding to know what you're looking for. So certainly, one thing that, would be identifiable, right away is if you look at the Schedule F balance sheet of the foreign corporation on the 5471, and you've got a balance sheet that does not balance. So what does that mean? Your total amount of your assets on the balance sheet does not tie to the total amount of the liabilities plus the shareholders' equity on the balance sheet. So you've got a balance sheet that is out of balance. That's something that, right off the bat, the IRS could pick up on and, identify as a red flag that your Form 5471 is not accurate and possibly not complete, which could lead them to, look at it more closely and try to identify any other errors. Another, major issue that you can spot from the face of the Form 5471 is where you've got income or loss on your income statement on the Schedule C of the 5471 for the foreign corporation, and your net income or net loss number does not correspond to the change from your beginning retained earnings to your ending retained earnings on the corporation's Schedule F balance sheet on the Form 5471. Now, it's possible that due to currency conversion conventions and methodologies that there may be a slight difference from your net income or loss reported on the Schedule C income statement and your change in your retained earnings on the balance sheet. But if it's off by a significant amount, you would want to understand if there are adjustments running through the retained earnings that are causing that difference. And if there aren't any special adjustments running through retained earnings, why doesn't your Schedule C net income or loss tie into the change in the retained earnings on the balance sheet? That's something that, you can look at quickly, calculate the change from the beginning to the ending retained earnings, see if that matches up to your net income or loss on the income statement. And if it's off by a huge amount, that could be a red flag. What is causing that? It could be something that is inaccurate, which the IRS could pick up on pretty easily. If you have loans and receivables due from or payables due to related parties on the balance sheet, but you're not reflecting these related party transactions on the Schedule M of the Form 5471 for a Category 4 filer, that could be an issue. Certainly, loans due to and due from shareholders and other related parties with respect to the foreign corporation are supposed to be reported on a specific line on the balance sheet. If you've got an indication on the balance sheet that you've got related party loans and the filer of the 5471 controls the foreign corporation, then you need to report those loans on the Schedule M of the Form 5471. Similarly, if you've got loans due from or due to related parties on the Schedule M, but you're not reporting those separately on the required line on the balance sheet, that's something that would be inconsistent that the IRS could identify as a possible issue. If your Schedule M reflects interest, dividends, rents, or royalty income or expense, but those items are not reported separately on the balance sheet, on the income statement, and there is not any Subpart F income being reported for that foreign corporation, that's something that could be an issue. And Subpart F income is a specific type of income with respect to a controlled foreign corporation, and it's basically an anti-deferral type of rule, which means that the U.S. shareholder could be required to report and pay tax on undistributed earnings of the CFC even before a dividend distribution is repatriated, and you have to identify and report Subpart F income on the Form 5471. If you've got these passive types of income on your income statement and you're not reflecting any Subpart F income on your 5471, you would want to make sure that the foreign corporation qualifies for the de minimis Subpart F income exception or another type of exception that would prevent that income from being characterized as Subpart F income. So another issue with the Schedule M on the 5471 is where you're filing more than one 5471 for related foreign corporations commonly controlled by the taxpayer, and you've got related party transactions that are not being reported consistently on the Schedule M on the different 5471s. That's something that the IRS can look at pretty easily and, see, well, you've got a one-sided transaction. Where's the other side of that transaction if all of these foreign corporations are related and commonly controlled? And the Schedule M is very important because the IRS looks to the Schedule M to identify transfer pricing issues. So transfer pricing basically requires intercompany transactions between commonly controlled companies to be reported in accordance with an arm's length pricing standard. And, when they're trying to pick up on, whether they're receivables or payables or intercompany loans or payments for services or intangibles between related corporations, the Schedule M is going to be the first place that the IRS will look. So it's important that everything is being reported consistently and that it's accurate and complete and that you have good books and records to support the information that's being reflected on the Schedule M. Another, significant error, which you can identify pretty easily from the face of the Form 5471, is where on the first page you've checked Category 2 or 3 for the applicable filer categories, and then you have not attached a Schedule O to the Form 5471. That's a huge red flag. The IRS can pick up on that very quickly, and if the Schedule O is not attached and completed, that can result in a $10,000 penalty to that filer of the Form 5471. So you need to make sure that if you have a U.S. officer or director of a foreign corporation in a year when a U.S. person acquires 10%, you're checking Category 2 as the applicable filer category box on the first page, but then you're also attaching Schedule O and completing the first section of the Schedule O. If it's a Category 3 filer for transactional events, such as the acquisition of 10% interest of the foreign corporation in the tax year, you have to make sure that the Schedule O Part 2 is completed and that the schedule is attached and filled out accurately. Again, if you're missing a Schedule O, that could automatically result in a $10,000 penalty. You want to avoid that. You don't want to give the IRS the opportunity to assess that penalty. It's definitely worth the time and effort and the diligence to make sure that you are identifying the correct filer categories and attaching all of the correct schedules, including the Schedule O. Schedule C, the income statement, where you've got an amount on the tax provision line, which could include current and deferred taxes paid or accrued, but then you are not reporting current taxes paid or accrued on the Schedule E of the Form 5471. That's, an issue where, what happened? Why is that not being reported consistently for current taxes paid or accrued? And that's really important because if your U.S. filer is a C corporation and they are potentially going to be able to claim the indirect foreign tax credit at some point, you want to be able to track the foreign taxes paid or accrued from year to year that have been reported accurately on the Schedule E. So again, Schedule C, the income statement, you've got passive income such as interest, dividends, rents, and royalties, and that income doesn't qualify for a de minimis subpart F exception. You have current year E&P, so current year net income, and you haven't reported any subpart F income on the Schedule I or the Schedule J of the Form 5471. These are issues that are, readily apparent from the face of the form if you know what you're looking for. Where you've got, on the Schedule F balance sheet, if you've got a loan due from a U.S. shareholder, you've got positive earnings and profits, and you haven't reported a Section 956 inclusion. So a 956 inclusion means that the foreign corporation has earnings invested in U.S. property. A lot of times that can result where the foreign corporation has made a loan to a U.S. shareholder. If you're showing a shareholder loan due from a U.S. shareholder on the balance sheet of the foreign corporation and you're not reporting a Section 956 inclusion, the question is, why not? It's possible that your quarterly average did not require an inclusion because it was or your E&P was less than the amount of the inclusion, but it's important to make sure that you're drilling down on these subpart F issues for CFCs and that you're not overlooking important information that has to be reported and which can impact the amount of taxable income that the shareholder is reporting on the tax return. So on another area which is identifiable from the face of the Form 5471 is on the Schedule J, where you haven't reflected current year distributions of non-previously taxed earnings and dividends, but you're showing a dividend on the Schedule I of the 5471. Or you've got subpart F income on the Schedule I, but you haven't reflected your subpart F income on the Schedule J. So all of these schedules are kind of they coordinate, and you have to make sure that the information is reported consistently. So another error that I tend to see in preparation sometimes is where the preparer has reflected the current year earnings and profits in U.S. dollars on the Schedule J instead of in the foreign functional currency of the foreign corporation. That's something that you can identify from looking at the amount of the net income in foreign currency in U.S. dollars on the income statement on the Schedule H, and then also tying to the Schedule J. So the IRS has that information with the net income in both the foreign currency and the U.S. dollars, and they can see whether the amount is being reported correctly in foreign currency on the Schedule J. So some errors that are kind of, beneath the surface of the 5471, underlying the face of the information return that, the IRS may not necessarily be able to pick up on as easily without, sending an IDR, an information document request, or initiating an audit of the tax return and requesting information about the foreign reporting. If you haven't properly converted your foreign corporation's financial statements so that they're presented in accordance with U.S. GAAP, then that could be a problem. That is a requirement for the Form 5471. You're supposed to take your foreign financial statements of the foreign corporation and you have to make adjustments to convert them so that they're consistent with U.S. generally accepted accounting principles. If you haven't done that, then that could be an issue if the IRS audits the taxpayer and finds out that you haven't properly reported U.S. GAAP compliant financial statements for the foreign corporation on the Form 5471. Another issue is where you haven't followed the correct methodology and convention for converting the foreign currency of the foreign corporation's financial statements into U.S. dollars. So on the income statement, you're supposed to use the IRS average rate for the tax year, or it can be the average rate. It doesn't necessarily have to be the IRS average rate because the IRS gives the average rate based on the calendar year. If you have a fiscal year, then you would use the average rate for the fiscal year. And then for the balance sheet, you're supposed to use the year-end exchange rate. And these are the exchange rates where you are dividing the foreign currency by the exchange rate to get the U.S. dollar amount. So that's different. That's a different convention and methodology than U.S. GAAP. So you need to be careful that you're reporting the financial statements in accordance with GAAP, but that you're following the correct methodology and convention for converting the financial statements into U.S. dollars. So another issue that could be underlying the face of the Form 5471 is where adequate books and records have not been maintained to keep track of intercompany and related party loans, receivables, payables, and other transactions. This can also be an issue for the 5472 where there are certain document maintenance and record-keeping requirements that you have to comply with. So certainly, anytime that you have a CFC, a controlled foreign corporation, and your taxpayer has to file a Schedule M on the 5471 to report related party transactions, you want to make sure that you are keeping good books and records to track those transactions so that if the IRS does audit that return, you can substantiate where those intercompany amounts are coming from and that they tie into the financial statements of the foreign corporation and the U.S. filer if it's a company. Another problem that may not be apparent from the face of the return, but which the IRS can certainly, look into and identify if they request additional information, is where you haven't been tracking your current year earnings and profits and your accumulated earnings and profits for the foreign corporation. If you haven't been making adjustments to your book net income or loss for the year to determine the amount of your earnings and profits, that can be a problem, and the IRS would be able to figure that out if they audit you and ask for an E&P study for that foreign corporation. Another issue is where you haven't been maintaining correct foreign tax pools for the foreign corporation, And this can be a problem where the shareholder, the filer of the 5471, is a U.S. C corporation. It's a parent company that could potentially be eligible to claim the indirect foreign tax credit with respect to foreign corporate taxes paid by the foreign corporation. The U.S. corporation, if they don't accurately calculate a Section 78 gross up on dividends received from the foreign subsidiary corporation, that's something kind of, beneath the surface of the 5471, which could be, recognizable or identifiable if the IRS asks for substantiation for your Section 78 gross up amount. And then also, if you haven't correctly calculated and reported the Section 902 and 960 deemed paid foreign tax credits, the indirect foreign tax credit for actual and deemed dividend distributions, that can be a problem that not only is beneath the surface of the 5471, but also can impact your foreign tax credit schedule. So all of these schedules are kind of interconnected. So it's very important that you have the substantiation in the proper documentation with the calculations to support what is being reflected on the surface of the Form 5471. So quickly, we'll take a look at a couple of these examples from the IRS International Practice Unit guidance. They identified basically 3 examples in the guidance. 2 of the examples relate to the Form 5471. One of the examples relates to the Form 5472. And I'll talk about the 5472 in a little more detail in just a minute. But we can see that example 1 was based on a field service advice issued by the IRS. And the IRS had concluded that the taxpayer did not substantially comply with the Form 5471 reporting requirements because there were significant understatements of purchases from and sales to controlled foreign corporations and related third parties that were reported on the Schedule M. So again, that Schedule M on the 5471, it's required to be completed by a Category 4 filer of the Form 5471. That's a Category 4 filer that controls a foreign corporation. And different types of related party transactions, any purchases or sales of inventory, goods, services exchanged, intangibles, any type of commercial business transaction where there's a payment accrued or paid between related parties, that has to be reported on the Schedule M. And if you're not reporting the correct amounts, and certainly where you've got related party sales of goods, and that could possibly give rise to Subpart F income, that is really a problem if you're not reflecting accurate amounts on the Schedule M and for the Subpart F income. That can be a major red flag, which apparently in this field service advice, the IRS was able to detect, in an audit, and they concluded that that was a reason why they did not have a substantially complete or compliant 5471. Again, the IRS was able to identify significant inconsistencies in the earnings and profits of controlled foreign corporations. Again, that may not be apparent from the surface of the Form 5471, but if the IRS starts investigating and they want more information and they send IDRs and they want an E&P study and they want to see your reconciliation of E&P from year to year since the CFC's inception or formation or acquisition, that can be a major issue for the taxpayer. And then evidently the taxpayer was able to report other information on the Form 5471 accurately, but that did not rise to the level of substantial compliance in the FSA in this example due to the fact that your Schedule M related party transactions and the E&P were not correct, consistent, or accurate. In example 2, a chief counsel advice issued by the IRS, they similarly had concluded that the taxpayer did not substantially comply with the Form 5471 reporting requirements, where the Schedule C income statement and the Schedule F balance sheet were not reported in accordance with U.S. GAAP. So again, I said earlier that it's really important that you take your foreign corporation's financial statements and you determine how to convert those into U.S. GAAP, because a lot of times foreign financial statements are going to be based on accounting principles, prevalent in that particular foreign country. They may be based on international financial reporting standards. They may not necessarily correspond to U.S. GAAP, so you have to make adjustments to convert them. And this may not be evident or apparent from the surface of the Form 5471, but the IRS could certainly identify and drill down on that if they do an audit and ask for additional information regarding how the financial statements were prepared to report on the Form 5471. In this Chief Counsel advice, in Example 2 in the IPU, Schedule O was not attached. That's a major red flag. If you're a Category 2 or 3 filer of the Form 5471 and you do not attach Schedule O, or if it's not completed correctly, you don't have Section 1 completed for a Category 2 filer, or you don't have Section 2 completed for a Category 3 filer, that can be a major red flag that the IRS can pick up on very easily, which can result in a penalty or can lead them to look further and possibly start an audit and ask for more information to try to detect other errors. So, these things, not converting to U.S. GAAP, not attaching the Schedule O, those can cause the Form 5471 to not be substantially compliant. And then another issue that the IRS raised in Example 2 was the fact that there were certain inactive or dormant foreign corporations for which the Form 5471 was not filed. If you have ownership of a foreign corporation and you are within the scope of the filer categories, you still have to file. If it's a dormant or inactive foreign corporation, it allows you to file under an exception where you only have to complete the first page of the Form 5471, so you don't have to do all of the required schedules that otherwise would be filed. You just have to make sure that you have the first page attached to the return for the Form 5471, and there's a checkbox that you would select in your tax return preparation software to indicate that you're filing under the procedure for an inactive or dormant foreign corporation. That allows the taxpayer or the filer to qualify for the exception so that they do not have to complete all of the otherwise required schedules. But if you don't file that first page of the Form 5471, that's a red flag, and it can result in the penalty per form, per corporation, per year. So again, these are some of the things that, I've tried to highlight in our discussion, which can result in possible penalty exposure where the taxpayer has not substantially complied with the Form 5471 filing requirements. And for the final example, this related to the Form 5472, which is required to be filed by a U.S. C corporation with a 25% direct or indirect foreign shareholder. And it's heavily focused on reporting intercompany transactions. If the transactions are not reported correctly, you've got, significant understatements or overstatements of amounts of reportable transactions. You're not reporting all of the transactions. You're not identifying the transactions correctly. That can lead to the penalties and a decision by the IRS that you did not substantially comply with the reporting requirement. And here, the IRS in the example has identified some specific errors with the 5472 that caused it not to be in substantial compliance. Again, a big red flag is where you've got beginning and ending balance sheet balances from the prior year to the current year that you're filing that do not tie, where your ending balance from the prior year does not roll into or correspond to the beginning balance of your balance sheet, or loan amount on the form, that's a real problem. You want to make sure that you're reporting things consistently from year to year, where there's information flowing from a prior year form onto a current year form. Another error in this example 3 from the IPU is where the taxpayer had overreported amounts and then underreported other amounts. That's a problem. You have to make sure that you're reporting accurately and that you have good backup and support in your documentation to substantiate these reportable transactions. So that brings us to the conclusion of my section of the presentation, and we will have some time to address questions from the audience. And I just want to point out quickly that I have included a lot of other information in the slide deck in the PowerPoint presentation regarding the Form 5471 preparation, and then also for the 5472. And this is, really a lot of detailed information about the mechanics of how to prepare the forms accurately and what has to be included. And certainly, I work extensively on the preparation of tax returns, including the foreign reporting for these forms. If you ever have any questions, please feel free to reach out to me. I'm happy to communicate with you and provide guidance or support as necessary. Because I know, a lot of tax advisors, as attorneys, you may not necessarily be involved in the day-to-day preparation of these forms, so you may not, be focused on exactly what to look for to figure out if it's, incomplete or accurate. But, this is just kind of like a guide on, the issues to help you understand and, be able to identify things if they ever come to you for review. So thanks again for taking the time to listen to the presentation. And Don, I think we are ready to begin with the Q&A.
All right. Very good. Thank you, Allison and Stephen, for your insights today. A brief announcement. New York State requires that you record and report the following code in order to earn CLE credits for the live or recorded version of this CLE webinar. So if you will be requesting CLE credits for this seminar, please write this code down. The code is TLDXFO. That's T as in Tango, L like lemon, D as in Delta, X like X-ray, F like Foxtrot, and O like Oscar. Again, that is TLDXFO. And now, on we go to our live question and answer session. Listeners can ask our presenters any questions relevant to today's topic. You may email those questions to taxlaw@stratfordpub.com or submit your question directly by typing it into the Q&A box at the bottom of the screen and hitting enter. You may also ask questions by telephone. To do so, please press *pound on your touch-tone phone. Again, that's *pound, and when it's your turn, you'll hear your microphone has been turned on and you have the floor. If for any reason you decide not to ask your question, pressing *pound will take you out of the question queue. And we do ask that if you ask a question by phone, that you please mute the speakers on your computer. And we will jump right into questions here from our audience. We'll start off with this one. If 5471 is also filed on behalf of other individuals, do we list the original person also on E of page 1?
So on section E of page 1 of the 5471, you can identify other individuals on whose behalf the Form 5471 is being filed by that particular taxpayer. So if you have a filer that's the taxpayer and they're attaching the Form 5471 to their specific tax return, they can file on some other individual's behalf if the filer has an equal to or greater percentage ownership in the foreign corporation, and the same filer categories apply to the taxpayer filing the return and to the other filers on whose behalf the Form 5471 is being filed. So you would not report the filer, the taxpayer's name in Section E. You would only report the other individuals on whose behalf the form is being filed by that taxpayer. So the taxpayer's name is at the top of the Form 5471. The other individuals' names and information appears on the Section E of the Form 5471.
All right, thank you, Allison. Up next, if you get a $10,000 penalty for late filing of foreign form, is there any way to get the penalty abated or reduced? If the reason is that your tax professional disappeared and you weren't able to locate him, would that be enough to get you some relief?
Yeah, this is Steve. Very good question. There are procedures for getting penalty abatement, and you file a request for abatement. It'll probably go to the service center first, and then likely you should be giving rights to IRS appeals. The question is there reasonable cause for late filing? And we get into a situation where what is the reason for the late filing? Tax professional disappeared in this. That's sort of a unforeseeable circumstance that might very well, get you out of the penalty, depending upon, let's say if the professional consistently prepared the forms timely, and then they just disappeared. But there could be a little pushback. The government has been starting to apply what I'll call it the Boyle Doctrine, B-O-Y-L-E, a Supreme Court case dealing with the failure to file an estate tax return, where the court held it's non-delegable and the executor had a duty to know the due date. That's a little different than the case posed by the question, but I think we will continue to see the government pushing back on this. There's always a tension, and you may be stuck with, and this was the point I made earlier, with having to go against the professional for the error caused. But it's a complex situation. But you would definitely take a shot at it, and a reasonable reviewer might very well abate the penalty in this circumstance.
I just would like to add that when you're trying to establish reasonable cause to get these foreign reporting penalties abated, that reliance on a tax professional can, in some cases, help establish reasonable cause. But the reliance has to be reasonable. The professional has to be a qualified professional, and the taxpayer has to demonstrate that they exercise ordinary care and prudence in making an effort to comply with their filing requirements. And, as Steve pointed out, it's questionable as to whether the taxpayer can effectively delegate the responsibility to file the tax return on time to the tax return preparer. Ultimately, it's the taxpayer, the filer's obligation to, determine if they're not getting any response from this tax professional and the person just disappears, then they obviously need to make other arrangements to make sure that they can file on time. I think, certainly the facts, would suggest that it is a reason that could potentially help establish reasonable cause. But again, the reliance on the professional has to be reasonable, and it has to have been a qualified tax professional that was, the person has to be competent and capable in the foreign reporting area.
All right, thank you. Regarding 5471 schedules, if a schedule is not applicable, such as Schedule O, for example, should they be attached with zeros, or should they not be filed?
Right. So if you're not a Category 2 or Category 3 filer of the Form 5471, then you're not required to file the Schedule O, and the Schedule O does not need to be attached to that Form 5471 filing. For example, if you're a Category 4 filer, and because you control a foreign corporation, you have ownership of a CFC for an uninterrupted period that includes 30 days during the tax year, then you would need to file a Schedule M. And even if you didn't have any related party transactions to report, the Schedule M would still have to be required. So you would, in that case, input like a 0 for the first line to activate the form in the software so it prints out with the 5471. But you would have to attach it if it's required. But if it's absolutely not required based on the filer category, then you do not have to attach it.
All right, thank you, Allison. Up next, does the reference ID need to be unique to each 5471?
So the reference ID number is any combination of alphanumeric characters, and it's specific to a particular foreign corporation. So if the taxpayer is filing a 5471 to report ownership of one particular foreign corporation, then they would create a separate reference ID number for that foreign corporation. But if they have to file a Form 5471 for other foreign corporations with the same tax return, there would be different reference ID numbers for the other foreign corporation. So it's specific to one particular foreign corporation, and you use the same number from year to year on your Form 5471 filing.
All right, there are 4 persons reporting on the same 5471, but some are directors and officers while others are not. Which category would that be, 2 or 3?
So a Category 2 filer is a U.S. individual that is a U.S. officer or director of the foreign corporation in a year when any U.S. person has acquired 10%. A Category 3 filer is a U.S. person that has acquired or disposed of a 10% interest in a foreign corporation. Normally, you can only file on behalf of another person if the other person is within the same filer category as the taxpayer filing the form, and the filer, the person, the taxpayer filing the form, has an equal or greater ownership percentage as the other person in the foreign corporation. So if you've got, a difference between the filer categories, then you may not necessarily be able to file on behalf of other people on the same Form 5471. So you need to be careful about that. And the other thing to note regarding penalties is that if the other person is relying on the taxpayer to file on their behalf, that taxpayer must disclose all required information for that other person, or otherwise the other person could still be subject to penalties. So a lot of times we don't necessarily recommend or advise being the person on whose behalf another person is filing because, sometimes you don't have control over the preparation of the form by that taxpayer to make sure that all required information is being disclosed. For example, if you're a Category 5 filer, you're a shareholder of a CFC, the person filing the 5471 has to make sure that the Schedule I is completed for each person who's filing or on whose behalf the form is being filed. If the taxpayer filing the form with their return does not include a Schedule I for the person on whose behalf the form is being filed, then it can be incomplete with respect to that other person and can potentially subject the other person to penalties. So it's usually advisable that if you have a filing requirement, make sure it's attached to your own tax return to mitigate exposure to penalties where the person, the taxpayer filing is, you're not relying on them to complete all the required schedules on your behalf.
All right, Allison, thank you very much. Moving on to our next question here from an attendee who writes, how do you reconcile the differences produced when converting the balance sheet at ELY exchange rates, but P&L at average rates?
You can run it through additional paid-in capital. That's an acceptable way to present it on the balance sheet on the 5471.
All right, we have 3 foreign related corporations and 3 individuals owning these for foreign corps in different percentages, do we consider total percent for each foreign corp or total for all individuals?
So when you're determining whether you have a controlled foreign corporation, you have to look at the aggregate ownership by U.S. persons. So if you've got a foreign corporation that is owned by more than one U.S. person that each person owns at least 10%, you add that up to figure out if you're above the 50% threshold. If you are, then you have a controlled foreign corporation. That's a Category 5 5471 filing requirement for each year when the foreign corporation is the CFC and the U.S. shareholder own the stock of the CFC on the last day of the tax year. So when you're determining CFC status, you have to look at ownership by U.S. persons and figure out if your U.S. shareholders have 10% each and whether that, when aggregated with all of the stock owned by the U.S. persons, is greater than 50%.
All right, thank you, Allison. Up next is the 5471 required only in a year when 10% is acquired or all subsequent years as well?
So the answer to that question is that it depends on whether the foreign corporation is controlled by U.S. persons who each own at least 10%. If you've got a CFC, which is a foreign corporation owned more than 50% by U.S. persons who each own at least 10% of the voting stock, then you're going to have an annual 5471 filing requirement as a Category 5 filer. If you have an acquisition of 10%, then you're a Category 3 filer in that year. And if you're a U.S. officer or director of a foreign corporation in a year when a U.S. person has acquired 10%, then you're a Category 2 filer for that year. And if you're a more than 50% shareholder of the foreign corporation, then you're a Category 4 filer. So you need to look at the filer categories closely. You can find those on the Form 5471 filing instructions on the IRS website and determine, whether you're within the scope of any of those filer categories. And you just need to, make sure you have a good working knowledge and understanding of, what the requirements are. And if you're not sure, it's a good idea to communicate with someone that has experience in the area.
If there is a change in a balance sheet item from one year to another, is it acceptable to attach a reconciling schedule showing why beginning and ending balance sheets don't agree?
Right. I think technically if you're restating your financial statements, your beginning balance sheet, or you're changing your beginning balance of your E&P, you are required to attach a statement, a disclosure explaining what the difference is and why you're reporting a different amount than the prior year ending amount. To the extent that you have good documentation, you could attach a reconciliation, but I think you just want to be mindful that, when you include a disclosure like that, it is going to kind of be a red flag to the IRS that maybe something wasn't reported accurately previously, and that, could lead to further, questioning by the IRS. So, obviously you want to make sure that you're in compliance and that you're adequately disclosing any changes. But again, you need to explain what the consequences could be to the taxpayer.
How do you approach non-compliance for prior years? And I think Steve wants a crack at this one.
Yes, thanks, Don. Carefully, I guess, is the word. Now there is a specific procedure set out by the Internal Revenue Service for delinquently, for late filed information returns. It's on the website, and basically it's a submission with a reasonable cause statement. And then they will determine whether they are going to assert penalties. We've done a fair number over the last, I guess it's been 2.5 years since they enacted the procedure, and they've been fairly accepting and liberal in accepting the 5471s without penalties. Prior to this specific procedure, that's the way it was done. Submit the delinquent 5471s with a statement of reasonable cause. They were more liberal years ago, but they still tend to accept them, and we've not seen a lot of assertions of penalties in those which we've gone in through the delinquent return procedure.
There are also some other amnesty procedures that the IRS has to allow taxpayers to remediate prior year delinquencies. So certainly the procedure that Steve described is the delinquent international information return submission procedures. They also have the delinquent FBAR submission procedures. And then, there are a couple others. There's the streamlined domestic and foreign offshore disclosure procedures, which to the extent that there was any unreported taxable income related to the foreign reporting for the prior years, the taxpayer can make a streamlined disclosure, file 3 years of original or amended returns. They have to be amended returns if you're in the streamlined domestic offshore program, but you can get caught up that way and then file 6 years of FBARs if those are delinquent as well. And then to the extent that, and I should point out that for the streamlined program, you have to make sure that the taxpayer can certify under penalties of perjury that the delinquencies were due to non-willful conduct. You have to include a non-willfulness statement of the position as the basis to qualify for that particular amnesty procedure. And then to the extent that you have a taxpayer with an intentional or willful delinquency in not filing FBARs or international information returns and there's unreported taxable income, then the IRS has the offshore voluntary disclosure program. The streamlined program for the domestic filers does carry a 5% penalty, and the offshore voluntary disclosure program has a 27.5% penalty, which could be increased in certain circumstances if the foreign financial institution where the accounts are maintained is being investigated by the U.S. government.
Have either of you seen other examples of information return errors resulting in noncompliance other than the CCA examples that were mentioned?
This is Steve. I have not. We've not had situations where we've had a number of situations where there were errors, omissions, but we've not had an agent assert the penalties because of them, even though they could have.
Right. I think in an audit, the agent really has to be looking for foreign reporting issues to, assess penalties within the scope of an audit. And they have to know what they're doing, and they have to, be capable and, be able to identify the issues that, warrant the assessment of the penalty. I personally work with a lot of middle market companies and taxpayers that are, probably not at the threshold of being considered high net worth individuals. So, the chances of, the IRS raising issues and, starting audits and scrutinizing more closely for those types of taxpayers is probably less than if you're dealing with like a multinational corporation, which has, a complex structure of foreign subsidiaries where, they're required to file like 8865s, 5471s, 8858s for foreign partnerships and disregarded entities in addition to foreign corporations. So I think the IRS is, somewhat limited in their resources in being able to, target taxpayers to begin an audit to drill down on foreign reporting issues. So it's not to say that they can't come after, people that are at lower levels of income that, are not involved in as complicated structures. But, I think you're probably, not at as high of a level of risk as like a multinational with a complex structure or a high net worth individual with ownership of, a lot of different foreign corporations.
All right, we have time for one more question, and then we'll move on to closing remarks. Our final question: if U.S. person claims treaty benefits, and therefore is exempt from filing a U.S. return, are they required to file the 5471 anyway?
Alice, go ahead, Allison.
So, if the U.S. taxpayer somehow can qualify for treaty benefits, I'm not aware of any particular treaty provisions that would allow an exemption from a Form 5471 filing requirement. I think, where we see treaty benefits applicable is where we have like a U.S. expatriate individual that, or a green card holder that is, trying to claim relief for something. And, I don't think that there's any particular treaty relief that is, going to allow an exemption from filing the Form 5471. I think that would still have to be filed. Even if you have relief for, taxable income on your tax return under a treaty, you still have a filing requirement to, file your return and attach the Form 5471 and make sure it gets filed on time to avoid the penalty.
All right. Thank you, Allison and Steve, for the excellent presentation and for your thoughtful response to the questions we received from our audience. We have a few moments remaining for closing thoughts, and Allison, perhaps we'll start with you, and then we'll wrap up with Steve.
So I think, certainly it's really important to, make sure that the taxpayer is working with a qualified tax professional that has experience with the international information return reporting. I work with a lot of clients where they, had perfectly capable and competent CPAs that just did not have the specialized international information return reporting experience, and that's where the taxpayers tend to get into trouble, where they didn't know that they had to file something, and they didn't necessarily communicate the information to the tax preparer because the tax preparer didn't ask for the information, and there's kind of like a miscommunication where the tax return preparer didn't know that the taxpayer was engaged in foreign activities, and it's just kind of a communication breakdown that's unfortunate, but can happen where the taxpayer is not working with someone that has the specialized capabilities. So unfortunately, this is an area of specialty tax services, and it's really critical to make sure that to avoid the penalties, that the forms are being prepared, that the questions are being asked, the information is being disclosed, and that it's an effort that is competent and in substantial compliance with the requirements.
Steve?
Thank you, Allison. I agree with all of Allison's comments, and as you can see, this is a highly technical area. I would keep in mind what I said before, exercise professional diligence, good faith, and that will get you a long way in terms of avoiding these penalties. It's a new world, and we are going to be faced with more scrutiny. But I think the level of expertise on the private practitioners is expanding every day. So I think we'll do okay. And just remember, good faith, rule of reason.
All right. Thank you to our audience. We hope you've enjoyed our national webinar, Form 5471, Substantial Compliance Rules, New IRS International Practice Unit Guidance. When will the IRS deem an international tax information filing as not substantially complete? If your question was not answered, you may email it directly to our presenters. Their email addresses are included in the presentation materials. If you will be seeking continuing education credit, you must verify your participation in this webinar by completing and submitting the attendance affirmation evaluation after the program. A link to this form will be included in the thank you email that you'll receive immediately following this event. As long as you've registered and paid for this program by 5 p.m. today, you will receive your certificate of attendance within 24 hours. If you have any questions about continuing education credit for this webinar, please call our Continuing Education Department at 404-881-1141, extension 35. Again, for those of you seeking standard tax or accounting continuing education credits, you will need to have responded to all of the pop-up prompts and recorded the final verification code. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 800-926-7926, extension 10, or visit Stratford's website at www.stratfordpub.com. And if you are not yet a Stratford Annual Pass holder, we invite you to try the CLE Individual Annual Pass. You can get all of your CLE credits for one low price. Simply respond to the email you'll be receiving after the program. Stratford would like to thank you for your attendance today. To end this call, simply hang up the phone. Thank you, and have a nice day.